When stocks crash, it's loud. Sirens wailing, headlines everywhere, red numbers flashing across the screen. But when the bond market moves, it's quiet, almost silent. And that's exactly why you need to pay attention. Because more often than you think, the bond market moves first, weeks, sometimes months before stocks finally get the memo. I know bonds don't have the glamour, no meme stocks, no rocket emojis, but if you want a peek at what the smart money is watching, you have to learn to hear what the bond market is quietly signaling. You might think stocks lead and bonds just follow along, or maybe you don't even invest in bonds, so why care? But that's looking at it completely backwards. See, stocks are emotional. They run on stories, on hope, on fear. Bonds, they're analytical. They run on cold, hard math. The bond market isn't asking what's the best case scenario. It's asking what is most likely to happen next. We're talking about a $50 trillion market dominated by institutions, pension funds, giant insurance companies. They aren't chasing hype. They're pricing in the future of growth and inflation. Think of it this way. Stocks are the thunder, loud, dramatic, impossible to ignore. But bonds are the weather radar. By the time you hear the thunder, the storm was already on the screen. This difference in mindset is everything. A stock investor asks, will this company beat its earnings? A bond investor asks a much simpler, more brutal question. Will I get my money back? It's a defensive game, and it makes them incredibly sensitive to the first signs of trouble. So what do they see? Let's start with yields. When interest rates rise, the basic math for valuing a stock changes. Imagine a company is expected to make $10 a share. If you discount that future money at 5%, the stock might be worth $200. But if rates go up and your discount rate becomes 7%, that same $10 in earnings is now only worth about $140. Nothing about the company changed, just the math. That's how rising yields quietly put the squeeze on stocks long before anyone's talking about falling profits. Then there's the yield curve. It's a subtle but incredibly powerful signal. Normally, you get paid more interest for lending money for a longer time. But sometimes, short-term rates rise above long-term rates. That's called an inverted curve. And historically, every single U.S. recession in the last 50 years was preceded by a yield curve inversion. It's the bond market saying, the future looks weaker than today. We'd rather lock in a lower rate now for safety. Stocks usually ignore this until they can't. Finally, you have credit spreads. That's the gap in interest rates between super safe government bonds and riskier corporate bonds. When that gap gets wider, it means fear is creeping in. Bond investors are demanding more to take on risk because they smell trouble before a company's earnings actually collapse. It's not just theory. Before the 2008 crash, the yield curve inverted and credit spreads blew out. Stocks kept climbing for a while, right before they fell off a cliff. So what's the takeaway here? You don't need to become a bond trader, you just need to listen to them. Think of these signals as an early warning system. They allow you to shift from reacting to panicky headlines to anticipating what might be coming. It's about being prepared. Because stocks tell stories, but bonds price reality. Stocks shout, bonds whisper. And the investors who survive and thrive are the ones who learn to listen to that whisper long before the shouting begins. Stay patient, stay curious, and keep thinking ahead.